Okay, so now we're working on exercise 17-18B, and the issue that's being illustrated in this exercise is the impairment of investment securities. So you've seen so far that when investment securities are classified as trading or available for sale, that we report those investments on the balance sheet at fair market value each period. And in the case of available for sale securities, any change in the value of the security that occurs during the year bypasses the income statement and is reported as a component of equity. You will remember that the carrying amount of the investment in securities asset account does not change. Rather, we use an adjunct account called fair value adjustment account to account for the difference between the cost of the security and the fair value of the security. Well, when the decline in a security is deemed to be other than temporary, just kind of accounting speak for we think that the security's value has gone down and is going to stay down for a long time. In that circumstance, the security is deemed to be impaired, and we have to write down the carrying amount of the security that's embedded in the investment in security asset account. We have to write that down to the lower fair market value, and that write down triggers a loss that is recognized in net income. So that's the issue being addressed here. So in 17-18B, we've got Waxer Company. They've got investments in bonds. The bonds are classified as available for sale. The bonds have a par value of $500,000, and if you flip to the company's general ledger and looked in the investment in available for sale securities account, you'd see that that bond is carried at its amortized cost of $500,000. The bond has a fair value of $425,000, and apparently sometime in the past that bond had a fair value of $425,000. So we prepared the normal journal entry that you see at the end of each period to establish a balance in the fair value adjustment account, so that when it's combined with the balance in the investment account, the net of those two equals fair value. So we got an investment in available for sale securities account with a cost of $500,000. We've got the fair value adjustment account that's got a $75,000 balance in it, and then the way that $75,000 credit balance got in the fair value adjustment account was sometime in the past we debited the unrealized holding gain or loss equity account for $75,000. All of this stuff happened sometime in the past. Now it's December 31st, 2014. We're inspecting these accounts. We look at the value of the bond and we realize, oops, that bond decline in value from $500,000 to $425,000. That decline is other than temporary. So as a result, the bond is deemed impaired, and we have to recognize an impairment loss for these bonds. So what we're going to do is prepare an adjusting journal entry that brings the balance in that investment account down from its current balance of $500,000 to $425,000. And of course that's going to involve a credit to that account of some amount. And that amount of course is $75,000. So the journal entry that we're going to have to make in order to reduce the carrying amount of that investment in AFAS securities general ledger account is going to be a credit to that account of $75,000, as I just mentioned, which you see here, and the offsetting debit to that credit is going to be to an income statement account called impairment loss on available for sale securities. This is the journal entry to recognize the other than temporary decline in the value of the bond. That impairment loss on available for sale security is just going to be a plain old loss account that appears on the company's income statement. Okay, so following this write-down, we've got a balance in the investment account of $425,000. We now no longer need a balance in the fair value adjustment account, because remember, the balance in the fair value adjustment account, when combined with the balance in the investment account, is supposed to result in a net or combined number that itself reflects the fair value of the investment. So if we were to stop right now and prepare no adjustment to the fair value adjustment account, we would have $425,000 debit offset against a $75,000 credit. So the net of that would be $350,000. We clearly do not want to show this investment on the balance sheet at $350,000 because that's not the fair value of the investment. The fair value of the investment is $425,000. So we desire a balance in this account now, the fair value adjustment account, of 0, because if we combine that 0 balance with the $425,000 new cost basis of the investment in available for sale securities, the combined amount represents the fair value of the security, which is what we want. So bottom line, we need a balance in the fair value adjustment account of $0 and a balance in the unrealized holding gain or loss dash equity account of $0, given that we have written down this investment to its fair value. So these two accounts need to be zeroed out. So the adjusting journal entry that we're going to make to do that is debit the fair value adjustment account, $75,000, that's here, and credit the unrealized holding gain or loss dash equity account, $75,000, that's here. When we do that, the resulting balance in the fair value adjustment account When we do that, the balance in the fair value adjustment account is going to be 0 as we desire, and the unrealized holding gain or loss account is going to be 0 as we desire. So $425,000 debit, the investment account, combined with a 0 balance in the fair value adjustment account, will result in us reporting this investment on the balance sheet at its fair market value of $425,000.